Welcome back to The Deep Dive. It is January 20th, 2026. And, we are firmly in that post-holiday window now.
We are. The decorations have packed away. The New Year's resolutions are maybe still happening.
Hopefully still holding up, yeah. And usually this is the time of year when the real estate market is just in a deep freeze.
Oh, absolutely. You expect hibernation.
You really do. You expect tumbleweeds rolling through the MLS, right? The agents are recovering, buyers are waiting for spring. It's supposed to be quiet.
That's the traditional rhythm of the housing market, for sure. The January data, which, reflects what happened in December, is almost always the sleepiest report of the year. It's the baseline for inactivity.
Right. But we are not looking at a traditional data set today. We've got a stack of reports on the desk from NTRIAS, that's the North Texas Real Estate Information Systems.
Yes.
And we need to get the pronunciation right on this from the get-go because our source material was very specific. It's net froze.
Like a snake. Net ris. It is absolutely a shibboleth in the Texas real estate community. If you walk in and say NTRES, they know you're not from around here.
They know immediately, exactly.
Yeah.
So we're looking at these net risk trends reports for the whole Dallas Metroplex, but we're really zooming in on this specific anomaly that's happening in Montague County.
Okay.
And to help us, we're also looking at a market strategy script from a local brokerage, Peet Realty, which gives us a little bit of that boots-on-the-ground narrative.
Which is so valuable. It puts the story behind the numbers.
It really does. And the reason we're doing this today is that the numbers coming out of Montague County for December 2025 are, frankly, bizarre. They break the rules.
It creates this fascinating friction. I mean, usually economic principles are pretty reliable, right? Demand goes up, price goes up, supply goes up, price goes down.
Simple.
But in Montague County, if you look at that year-over-year data, December 2024 to December 2025, those lines have crossed in a way that suggests something really significant is shifting in that rural market.
Okay, so let's just tease that out before we really dive into the spreadsheets.
Yeah.
We have a situation where it seems like everyone is rushing to buy something. The sales volume has just exploded, but the prices, they've dropped, and not by a little, significantly.
Soaring sales, dipping prices.
Exactly. I'm calling it the Montague anomaly. So our mission today is to figure out, is this a crash? Is this some sort of correction? Or is this maybe the single best buying opportunity in the entire state of Texas right now?
And that frames the classic debate, doesn't it? Market velocity versus market value. And to really get our heads around it, we have to stick to that year-over-year comparison. We can't look at November versus December.
No, that's just seasonal noise.
It's just holiday chatter. We have to look at December 24 versus December 25 to see how the actual DNA of this market has changed in 12 months.
And the change is, it's drastic. So let's start with a headline that really jumped off the page at me. Section 1, the volume explosion. I'm looking at the Trends 2 report for Montague County.
This is the pulse check, the first thing you look at.
Okay, so get this. In December 2024, there were 9 closed sales in Montague County. 9.
Sounds about right. For a rural county, in winter, that's a very thin market.
Right.
And, when you only have single-digit sales, 1 or 2 big transactions can skew the data, but it generally indicates a quiet, stable, maybe slightly stagnant environment.
Exactly. So now fast forward to December 2025, last month, 21 closed sales.
Wow. Okay, so that's more than double.
It's a 133.3% increase in closed sales.
133%. To put that in perspective for you, in a mature, stabilized market like, say, Dallas or Collin County, a 10 or 15% swing in volume is headline news.
That's a big deal.
It's a huge deal. Seeing a 133% increase it's a flood. It suggests that the liquidity of the market, the ease with which you can turn a house into cash, has just fundamentally altered.
It's like someone found a main valve and just cranked it open, full blast. But here's the thing about a faucet. It needs water coming from somewhere, right? You can't have sales without sellers.
And that's the second part of the velocity equation. You have to look at where the product is coming from.
So if we look at new listings in that same report, they're up 53.3%. We went from 15 new listings in December 24 to 23 in December 25.
Okay, so a big jump in new inventory, too.
And this connects directly to that script we have from Peet Realty. They talk a lot about the market softness of the past couple of years and the whole rate lock phenomenon.
The rate lock has been the defining feature of the housing market for, 2 years now? You had millions of homeowners sitting on these incredible 3%, maybe 4% mortgages.
The golden handcuffs?
Absolutely.
Yeah.
Even if they wanted to move, they needed a bigger house for the kids or they wanted to downsize, they looked at the 7% rates out there and just said, no thanks, I'm staying put. It froze the inventory solid.
And the Peet Realty script specifically calls out rates trending under 6% as the trigger point.
And that psychological barrier of 6% is incredibly powerful. It just feels different. So the script is essentially telling us that the dam is broken. As rates dipped below 6% in late 2025, that lock-in effect started to dissolve.
Right.
Sellers who had been on the fence for 2 years finally felt comfortable enough to list their homes. And that explains your 53% jump in listings.
And at the same time, you had all this pent-up demand from buyers who were also waiting for lower rates.
A huge pool of them.
So those new listings were just immediately absorbed, and that gets you the 133% jump in sales. It's like a release valve.
It's a perfect storm of supply and demand hitting the market at the exact same moment.
But let's just pause and look at the relationship between those two numbers, because this is where it gets interesting. Sales are up 133%. Listings are only up 53%. If I'm doing some quick back-of-the-napkin math here, if sales are outpacing listings by that much, the shelves should be empty. We should have zero inventory left.
That's the scarcity model we've all gotten used to seeing over the last few years. High demand, low supply, prices to the moon.
Right.
But look at the homes for sale metric. That's the snapshot of active inventory at the end of the month. It's actually up.
It is. It grew by 12.6%.
So that's the puzzle.
Wait, how? How can sales more than double, which should be draining the pool, but the water level in the pool still goes up?
It implies velocity. It's about turnover. Think of a stagnant pond versus a rushing river. In 2024, Montague was a pond. Not much coming in, not much going out. The water level is pretty stable.
Okay, I'm with you.
In 2025, it's a river.
Yeah.
You have a massive amount of water, the new listings pouring in upstream, and a massive amount of water, the sales pouring out downstream. And even though the outflow huge, the inflow is strong enough to keep that water level rising slightly.
That is a great analogy. So it's not a shallow market, it's just a fast-moving one, a high-turnover environment.
Exactly. It signifies a highly liquid market. Houses are not sitting, they are churning. And usually, when you have a churning market with that kind of massive demand, prices go through the roof.
Oh, absolutely. If 21 people are suddenly fighting to buy homes in a small county, you expect bidding wars. You expect escalation clauses.
You expect chaos.
Which leads us to the most confusing part of this whole deep dive. Section 2, the price paradox. Because if I'm a seller in Montague and I hear sales are up 133%, I'm popping the champagne. I'm thinking I'm about to set a record price for my neighborhood.
And you would be in for a very rude awakening if you looked at the median price data.
Boy.
According to this Trends 2 report, the median sales price in Montague County for December dropped 21.2%.
That's a crash level number. We are talking about the median price falling down to the, $245,000 range?
And it gets even starker if you filter for just single-family residences. Sometimes rural data gets a little messy with big land sales or commercial plots mixed in.
Sure, that can skew things.
But if we just look at houses, places where people actually live, the median price dropped 27%. It went from the mid-300s all the way down to $266,250.
Okay, stop the bus. Demand is up 133%. The market is moving fast. But the price of the actual asset has lost a quarter of its value in 12 months. How is that even mathematically possible? Is the market collapsing?
This is where we have to be really careful and distinguish between depreciation and composition.
Yeah.
A crash or depreciation usually implies that a specific house, your house, is worth less today than it was yesterday. But I don't think that's what this data is showing. This looks like a composition shift.
Unpack that for us. What do you mean by composition?
Okay, imagine a car dealership. In 2024, they sold 10 big luxury SUVs for $80,000 each. Their median sales price was $80,000.
Simple enough.
In 2025, interest rates change. The economy shifts. Now, they only sell 5 of those big SUVs, but they also sell 50 compact sedans for $25,000 each. Their sales volume has skyrocketed. They sold way more cars. But their median price has crashed. because the mix of what they are selling has shifted dramatically downward.
So you're saying the velocity we're seeing in Montague isn't happening at the top end of the market with the big ranches.
Yeah.
It's happening at the bottom end.
The data supports that theory entirely. Just look at the average sales price versus the median sales price. The average dropped 12%. The median dropped 27%.
It's a huge gap.
It's a massive gap. And when the median drops more than twice as fast as the average, that's a major statistical signal. It tells you there is a heavy, heavy concentration of activity at the lower price points, and it's dragging that midpoint down. The boom in Montague is a boom in affordable housing.
That makes so much sense. It's not the luxury properties flying off the shelf. It's the starter homes, the fixer-uppers, the $250,000 houses.
Correct. And this creates a very, very unique market condition. To really understand it, we need to look at the month supply of inventory. That metric really tells the story of who has the power.
I have that circled here in red ink. Montague has 10.3 months of inventory.
10.3.
And that's up 27.2% from last year.
Let's just define that for the listener because it's such a crucial metric. Month supply means that if no new houses came on the market starting today, it would take 10.3 months to sell everything that is currently listed at the current pace of sales.
And the rule of thumb is that 6 months is a balanced market, right? Where neither buyer nor seller really has the upper hand.
Exactly. Anything under 6 months, that's a seller's market. That's scarcity. That's bidding wars. Anything over 6 months is a buyer's market. It's abundance. Buyers have choices.
So Montague is at 10.3 months. That is historically a deep, deep buyer's market.
It is.
But wait, a buyer's market usually feels slow, sluggish. You picture sellers just begging for offers. But we just established that sales are up 133%. It's a frenzy.
And that is the anomaly. We have a high-velocity buyer's market. It is extremely rare. It's a unicorn.
Yeah.
It means buyers have a ton of choices, 10 months worth of choices, but they are making their decisions incredibly rapidly.
So as a buyer, it's like I walk into the grocery store, the shelves are fully stocked, but I see other shoppers just grabbing things off the shelves at a furious pace.
That's a perfect way to put it. It creates a fascinating psychological pressure. You don't feel the scarcity panic of 2021 where there was literally nothing to buy, but you also don't feel the lethargy of 2008 where nothing was moving at all. You feel opportunity, but you also feel momentum.
So if I'm a seller holding a listing in Montague, what does that mean for me? Do I have any power at all?
You have liquidity, but you don't have pricing power. That is the fundamental trade-off. Because there are 10 months of inventory out there, buyers can and will walk away if you are overpriced.
They'll just go to the house down the street.
Instantly.
Yeah.
But because sales are up 133%, if you price it correctly at that $260,000 sweet spot, you can get out of the market very, very quickly.
It really sounds like the sellers in Montague have collectively decided that done is better than perfect.
I think that is a very fair assessment. They are choosing movement over margin.
Now, whenever we see a localized weirdness like this, the first thing I want to know is this contagious? Is this happening all over North Texas, or is Montague just some kind of weird island?
This is where the regional context becomes absolutely vital. You cannot understand Montague without looking at its neighbors.
Yep.
So we need to pull up the Market Watch report for Q4 2025 and look at Clay County and Jack County.
Okay, let's start with Clay County. It's the neighbor to the northwest.
Clay County is behaving in a completely different, almost opposite way. The median price there jumped 77.1%.
Whoa. Nearly 80% price growth in a year. That feels unstable.
It is extremely volatile. But now look at the volume. They only had 8 closed sales in the entire fourth quarter. Montague had 56.
Okay, so Clay County is a high-priced, very low-volume market. It's exclusive. It's hard to get into.
It's illiquid. Now let's look at Jack County to the southwest.
Okay, Jack County. Median price is up 54.5%, and it's hitting $390,000.
Nearly $400,000 for the median home in Jack County. So visualize the map for a second. You've got Clay to the northwest, skyrocketing to nearly $300K. You have Jack to the southwest, booming to nearly $400K, and sitting right in the middle.
It's Montague at $245,000.
It's the hole in the donut. It is the island of affordability.
That explains the volume explosion perfectly. It's the classic substitution effect. If I'm a buyer looking for a rural home or some land north of the Metroplex, and I look at Jack County at $400,000, and then I see Montague essentially offering the same lifestyle, the same landscape for $260,000.
The decision makes itself. Why would you pay a 50% premium just to be across the county line? This strongly suggests that the boom in Montague is actually a spillover event. People are being priced out of Jack and Clay, and they're flooding into Montague.
And what about the people coming out from the city? We always hear about that migration narrative, people leaving Dallas for more space.
The data confirms that too. Look at Dallas County and Tarrant County prices in the reports. Dallas is down 1.7%. Tarrant is down 2.3%. The urban core is stagnant. It's cooling off.
So the heat is radiating outwards to the edges.
But not just to any edge. It's moving to the value edge. Buyers are smart. They're not going to the expensive rural counties anymore. They are hunting for the deal. And right now, Montague is the undisputed value leader of that whole region.
It's the clearance rack of North Texas real estate.
In the best possible way for a buyer, yes.
I want to drill down a little deeper into what is actually selling. We touched on this composition idea, but let's look at the Trends 4 report, which breaks it down by property type. Because, sometimes these rural stats get skewed by a bunch of mobile homes or huge farm acreages.
That is a very common trap in rural analysis. A handful of double wides can absolutely tank your median price if you're not careful with the data.
Right. So looking at the Montague data, mobile and manufactured home sales were, negligible. There was one sale.
Okay, so this is not a mobile home story.
Not at all. But single-family residences, SFRs, that is the engine. There were 18 sales in this specific summary, which represents a 100% increase over the previous year. This is a housing story. This is people buying permanent structures to live in.
And if that's the case, we need to look at the speed of sale for those houses. We mentioned earlier that the inventory is high 10 months worth. Usually, in a market with that much supply, houses just sit.
They collect cobwebs.
Exactly. You'd expect the days on market, the DOM, to be 120, maybe 150 days.
Right. The for sale sign starts to fade in the sun.
But look at the DOM for Montague. It dropped to 78 days.
78.
That's an 18.8% decrease. The market got faster.
That is incredibly fast. Less than 3 months to find a buyer and close in a rural market in the dead of winter.
It's exceptionally fast for a so-called buyer's market. And this just confirms our theory about the sellers. In some markets, sellers live in denial. They list their home at the wish price, the 2022 peak price, and they just let it sit for 6 months.
You hear it all the time. I know what I've got. I'm not giving it away.
That's the one. But in Montague, the DOM dropping like that tells us that the sellers are realistic. They are pricing their homes to sell now. They're cutting to the chase. They see the competition, those 10 months of supply, and they are pricing aggressively to be the one that sells, not the one that sits.
And the percentage of list price metric seems to back that up. It says here sellers received 91.5% of their original list price.
Which is actually up just slightly, by 0.5% from last year.
So the market is functioning properly. A seller lists it, a buyer comes in and negotiates maybe 8 or 9% off, which is a healthy chunk for a buyer. And the seller says, yes, deal.
That shows a willing buyer and a willing seller. A broken market is one where you have a wide gap. Buyers are offering 80%, sellers are demanding 100%, and nothing happens. Here, the gap is bridgeable. The deal is getting done.
It just so happens that the deal is being done at a lower starting price point than in the neighboring counties.
Precisely.
Which brings us to the practical application of all this. Section 5, the strategy. We have this script from David Peet at Peet Realty. And obviously he's an agent. His job is to generate business. His core pitch is list now to beat the rush.
You always have to view these kinds of strategy scripts through the lens of the author's intent. But just because he's selling something doesn't mean he's wrong.
Well, his core argument is, quote, as rates drop, the market will heat up. He's urging people to get their properties ready now, in January 2026. Based on the data we just crunched, is that good advice?
I think he's actually understating it. He says the market will heat up. The data we're looking at says the market has already heated up.
That's a great point.
The sales volume is already up 133%. The train has already left the station.
So if you wait until the traditional spring rush in, say, April,
you might be entering a much more chaotic environment. If this velocity continues, that 10-month inventory surplus is going to get chewed up very quickly. But also, you'll be competing with every other seller who waited for the flowers to bloom. Listing in January into this specific wave of demand seems like a very sharp tactical move.
Okay, but there is one part of his script I want to challenge you on. He mentions asking about ROI for improvements. The script says, call us to see what investments you can make to improve market value.
And that is the dangerous part of the advice.
Why do you say that?
Because of the price paradox we've been talking about. The median price is falling. We're down 27% on single-family homes. In a market where values are actively compressing, the over-improvement trap is absolutely deadly.
Explain the trap?
Okay, if you own a home in Montague and you spend $50,000 on a brand new luxury kitchen renovation, hoping to raise your asking price from, say, $275 to $350, you have just priced yourself completely out of the market.
Because the buyers who are flooding into the county are there specifically for the $260,000 price point.
Exactly. They are escaping the high prices of Jack and Clay counties. If you make your house expensive, you have just removed the primary reason they were looking at it in the first place. You were trying to sell a Ferrari in a Toyota showroom. It's the wrong product for the current customer.
So if you're a seller, what should you do instead? No improvements at all.
No, you should focus on sellability, not value add. There are two different things.
Okay.
Do the paint. Fix the leaky roof. Clean the carpets. Make the house liquid. Do the things that allow it to sell in 78 days. But do not try to force appreciation through renovation. You will not get that money back in a falling price environment.
That is such a critical distinction. Spending money to sell the house versus spending money to increase the value of the house.
In this specific market, at this specific time, those are two very different strategies with very different outcomes.
Let's look into the crystal ball for our last section here. Future speculation. We are starting 2026 with rates under 6%. If that trend continues, if we see 5.5% later this year, what happens to the Montague anomaly? Does the price just stay low forever?
History would suggest no. Economic gravity eventually takes over. High volume is almost always a leading indicator for price growth.
Volume leads price.
Yes. Think of it like starting a fire. The volume, the number of sales, that's the kindling catching fire. It burns really fast and hot, but it doesn't give off a lot of heat. The price appreciation, that's the radiant heat that comes later once the big logs catch.
So right now, Montague is just burning through the kindling.
It's burning through the slack in the market.
Yeah.
We have 10.3 months of supply. That sounds like a lot. But if sales continue at this pace, doubling year over year, that supply number is going to drop very, very rapidly.
10 months becomes 9, it becomes 8.
Exactly. And once it hits that 6-month mark, that's the tipping point.
That's when the market balance flips from buyer to seller.
And that is when prices will likely slingshot. Because look at the map again. Montague is surrounded by appreciation. Clay is up. Jack is up. Montague is the anomaly. And markets, over time, tend to revert to the mean. They equalize. It is highly, highly unlikely that Montague will permanently trade at a 50% discount to its immediate neighbors.
So the gap will close?
Eventually, yes. The arbitrage window will shut. Prices in Montague will, in all likelihood, rise to meet the regional standard.
So if you're listening to this and you're a potential buyer,
you are looking at what I would call a coiled spring. You have this unique, maybe short-lived window right now where rates are down, prices are down 27%, and inventory is high. It's the buyer's trifecta. But because volume is up 133%, that window is closing faster than you think.
It's a falling knife in terms of current price, but a coiled spring in terms of future potential.
I like that. And the smart money, the 21 people who bought houses there in December, they clearly think it's a coiled spring.
And what about for the seller?
For the seller, it's an exit strategy. You might not get the peak 2022 price. That ship has sailed. But you can sell. You can move. You aren't stuck anymore. And in a world where real estate can be frighteningly illiquid, being able to cash out in 78 days is a huge win.
You know, I want to touch on one last thing from the source material, which was the tone. The Peet Realty script specifically asked for a Texas-friendly tone, warmth and confidence.
And it serves as a good reminder that all real estate is hyper-local. We get absolutely bombarded with national news headlines, U.S. housing market crashes, or East Coast inventory spikes. But if you applied those headlines to Montague County right now, you would be 100% wrong.
The national narrative completely misses the nuance.
It washes out all the anomalies. Montague County is behaving according to its own unique set of physics right now. It is bucking the trend of its neighbors, the Metroplex, and probably the nation.
And that is why you have to actually read the net risk reports. You have to get your boots muddy in the local data.
The macro often lies, the micro tells the truth.
So let's wrap this up with the elevator pitch. If someone stops you and asks, what is going on in Montague County? What do you tell them in 3 points?
Okay. Point 1. The volume has exploded. Sales are up 133%. The market has woken up from a very long hibernation.
Point two.
Prices have corrected, and corrected significantly, down 21 to 27%. It is, for now, the value pocket of North Texas.
And point three.
It's a high-velocity buyer's market.
Yeah.
You have choices, but you have to move fast because that inventory is churning. It's a rare and powerful combination.
It really is. It's a rare moment where the data tells such a clear story, but you have to read past the scary headlines to actually see it.
And I'll leave you with one final thought to mull over if I can.
Please, what's that?
We see Clay County's prices up 77%. We see Jack County's up 54%. And we see Montague down 21%. If you believe that markets are even remotely efficient, that massive gap represents one of two things. Either Montague County is fundamentally broken in some way, or it is simply lagging. And if it's just lagging, then we are looking at a potential 50% appreciation just to catch up to its neighbors in the next 18 to 24 months.
And that is the multi-million-dollar question, isn't it? Are you buying a problem, or are you buying a historic opportunity?
The velocity of the market suggests you're buying opportunity.
I love that. Well, that is all the time we have for this deep dive. Whether you're buying, selling, or just watching the numbers from the sidelines, keep unpacking the data.
And keep watching the anomaly.
Thanks for listening, everyone. We'll catch you on the next one.